Iran war spiked to $119 a barrel before pulling back to $115, sending all three major U.S. indexes down roughly 0.8%, 0.9%. The Strait of Hormuz, through which 20% of global oil passes, remains partially blocked as the Iran conflict enters its third week. The war has already cost the U.S. $16.5 billion in its first 12 days, an average of $1.38 billion per day, and the Pentagon has informally raised a request for up to $200 billion in additional funding, which at current spending rates could sustain operations through mid-August. The oil shock has done something few predicted a month ago. It flipped the rate outlook. Gold-to-oil crash squeezes miners. The probability of a Fed rate cut within 3 months has collapsed from 60% in early February to just 16%, while rate hike odds have climbed to 15%, briefly touching 25% last week. Fed Chair Powell held rates steady at 3.5%, 3.75%, but admitted we just don't know what the Iran conflict means for the economy, a phrase he repeated 17 times during his press conference. The 30-year mortgage rate climbed to 6.22%, its highest level of 2026, directly tracing the Treasury yield surge driven by inflation fears. Mag 7 splits, NVDA versus the rest. Yardeni Research has raised its stagflation probability to 35%, though Powell rejected the framing as a 1970s term. This energy shock is hitting miners with a double squeeze. Gold has dropped 13% month to date, while diesel, a major input for heavy equipment, has surged 61% since the conflict began. The gold-to-Brent ratio has plunged 43%, its worst monthly performance against crude since December 1973. Energy costs represent 15% to 20% of cash costs at major mining operations, so falling revenue and rising expenses are compressing margins simultaneously.